Joining us now is GenTrust Managing Director Mimi Duff and Clearbridge Investments Chief Investment Strategist Jeff Schulze. Guys, welcome. Mimi, you think the risk at this point, as we're on the other side of Labor Day, is in being overweight equities and leaning too much into stocks? Meaning what? What should the people playing at home expect to happen, and maybe how should they be positioned for it?
Yeah, so as you mentioned, we're underweight equities here. September is broadly a weak seasonal month, and we feel that thus far, year to date, the earnings expectations have beaten, but the bar right now is extraordinarily high to keep carrying that out. And on the rate side, these higher interest rates that we're clearly in restrictive territory, and we think as time goes by, some of that cost of funds being higher will trickle through into the real economy.
And Jeff, that's just pressure, right, on the economy, on markets coming from, I mean, you saw the 10-year up today as well, so the 10-year yield. How much cash should people be raising here, or how much should they expect equity upside? How do you balance risk in this environment?
Well, I think last week you clearly saw that bad news was good news as the labor market was becoming more balanced. You started to see a little bit of a weakening there that we haven't seen in quite some time. Today, you actually got fit with the reality that the Fed is going to have higher for longer policy. This is why the 10-year Treasury is up and the 2-year Treasury is up. They've taken a cut out of next year's rate expectations. And I think that we may be in this situation as the labor market continues to soften from here, that investors are going to cheer that development over the course of the next month or two. But I think as we get to November, I think bad news ends up being bad news when it comes to the economy, because we think, although the soft landing was going to be the first destination as labor markets have started to soften, we think that the Fed isn't going to be pivoting anytime soon. And with no new fiscal stimulus on the horizon, we think this will ultimately end up in a hard landing scenario. So
Jeff,
while the markets could hang in there.
How soon are we going to get bad news? You mentioned November. That's when you start to get a sense of holiday and pre-holiday sales and those first e-commerce numbers, maybe even a sense of where inventories are. So given how stretched the consumer has been, delinquencies, the credit position, high credit card debt, is it going to be a Merry Christmas?
I don't think it will be. Yes, you had a really strong retail sales print, but there are signs of cracks on the foundation underneath. The San Francisco Fed came out with a release here recently that suggested that all of the excess savings is up this quarter for the consumer. You have the resumption of student loan repayments. Gasoline prices are up 20% here year to date. You're seeing a rise of delinquencies in credit cards, autos, other credit. And this is an environment with a really strong labor market. So when you put that mosaic together, coupled with the fact that revolving credit was down for the first time since 2021 this last month because of record high interest rates and tightening of lending standards, we think that there's some signs that the consumer, although holding in there now, is not going to be there once we get closer to the holiday season.
That all makes sense, but Mimi, this is part of that same narrative that was supposed to make all of 2023 bad for stocks. And here we are in September, and it's been pretty good for people who were long equities. So when you look at both the consumer situation overall and you look at financials, what do you do with that?
Yeah, so to your point, it's been a great year already for equities. We came into the year squarely neutral, to be fair. And to the other guest's point, all those things are true. Now's not the time to be underweight fixed income for that reason. So we are seeing a glut of issuance on the corporate side. That's typical in September. And we would use these coming months to make sure that you're not underweight fixed income in case we do see an economy that slides. That duration should help offset any weakness in equities.
So what specifically should investors get into on the fixed income side?
So we like diversified portfolios, but we also like exposure to front-end tips with break-evens in the 1.5% to 2%. We think that gives you a lot of optionality. With year-over-year inflation running in the low 3%, it just is, it's really priced for perfection, and we see inflation being a bit stickier.